This is Innovative Tax Strategies for Investors in 2014 Tax Update. This is presented by the Borg firm, PLLC. I am Keith Borg, a certified public accountant. I'm also an active real estate investor. I personally own 9 rental properties. My better half runs our fix and flip business and wholesale business. In addition, I also office with attorneys, a title company, and a hard money lending company. We also have a deal with a hedge fund that we started about a year and a half ago. When we first started that deal, I was out of my tax season, so for the first 6 months I served as a director of acquisitions for Texas and oversaw the purchase of over 350 houses through auction at courthouse steps, MLS, and also working with other wholesalers. I'm personally also an advanced certified pro advisor, which is the highest level certification available through QuickBooks. This presentation is for educational purposes only and is not to be construed as legal, tax, or other professional advice. Any tax advice contained in this presentation was not intended or to be written to be used and cannot be used by the recipient for the purpose of avoiding penalties that may be imposed under the Internal Revenue Code or applicable state or local tax law provisions. Before using any tax advice contained in this article, taxpayers should seek advice based on the taxpayer's individual circumstances from an independent tax advisor. So why do we do tax strategies? Well, for one, it gives us a competitive advantage. Traditionally, CPAs simply record history. They take your information at the end of the year, usually in March or April, and they enter it into their tax software, and you just kind of see what you get, and they make the best of it. It's often too late to take certain strategies and take advantage of deductions that needed to be done in the prior year. A good CPA will help you make history and will review available strategies and guide you through their implementation. Most of these tax strategies are implemented year-round, so really anytime you have any sort of a big decision, you should be thinking about the tax consequences associated with that financial decision and think through what the tax ramifications will be. Now, in order to take advantage of these tax strategies and deductions, you need to have good record keeping so you can ensure that you have the proper documentation should you be audited. The other benefit with taking advantage of these tax strategies is you get more cash. There's more money that you can invest back into your investments or possibly take a vacation or do something else with that cash. I'm sure we could all use a little extra money. So this is what we're up against. This is the 2014 tax brackets. One of the common mistakes I see people make when they're first starting out is they think that if they make $100,000, if they're single, that they're taxed, all their income is taxed at the 28% tax bracket. In reality, the tax brackets are a graduation of income. So the first $0 to $9,000 or so would be taxed at 10%. The next $9,000 to $37,000 or so would be taxed at 15%, and so on and so forth. I also see a huge opportunity here. Let's say you're married filing joint and you're just kind of starting off in real estate, so your income's not too high. You can qualify for long-term capital gains, and you can sell an asset at 0% capital gains rate. So what qualifies for long-term capital gains? This is any sort of an asset such as stock, bonds, a house, or something else that you've held for a year or more. Once you've held it for a year or more, then it qualifies for this long-term capital gains treatment. So you could potentially sell a house as long as the gain from that capital gain and your income is less than the $74,000 range. If you're married filing joint, you can pay 0 tax on the sale of that asset. Now on the other end, if you're over the $458,000 or so for married filing joint, there's a 20% tax bracket that kicks in for long-term capital gains. So this is something that you would like to try and avoid. I'm sure that's an additional 5% tax, and that adds up quickly. So ways to avoid that would be to split up your whatever that sale is over a period of time. So instead, if you're going to sell a land or a building, instead of selling it immediately in the first year that you want to sell it, maybe you do an installment sale or owner finance where you agree to sell it to somebody over 5 years. So then you're recognizing that gain over 5 years. If it's a $2 million sale, that's about $400,000 per year. You could get more of that income at that lower capital gains rate. Additional taxes. As an employee, you are taxed at 7.65% off your paycheck. That comes right off the top. You're never going to see that. That's the employee side of things. There's also an additional Medicare payroll tax that kicks in once your wages go above the $200,000 if your adjusted gross income is $200,000 or more if you're single, or $250,000 if you're married filing joint. There's also a 3.8% Medicare tax that kicks in also on your investment income once your income exceeds the portion of your investment income that exceeds $250,000. We're going to go over that in a little more detail here in a moment. Your itemized deductions and your adjusted gross income will also begin to phase out once your income levels reach the 254 and 305 adjusted gross income levels respectively if you're single or married filing joint. If you're self-employed, you get to pay both sides of the tax. So as an employee, you pay 7.65%. As an employer, you're paying 7.65% to have that employee. However, if you're self-employed, you get to pay both sides of that tax. So if you end up flipping houses and it becomes a business for you, you're subject to the short-term capital gains, which is whatever your ordinary tax bracket is. Maybe that's 30%. Plus, you can lump on an additional 15.3% in tax after that. So you're easily over 45% in taxes on whatever gain on the sale from a flip if it's a business. Now, if you live in other states, there will also be additional state taxes on top of the federal taxes. However, in the great state of Texas, there is no state income tax. Now, if you have an LLC, you can be subject to a 1% tax based on your gross receipts. And you only need to think about this tax once your gross revenue exceeds $1,080,000. So it's really kind of a nice problem to have if you're at that kind of level. And like I said, it's only at a maximum of 1% of your gross receipts. Now, unrelated business income tax. This would apply to potentially apply to those folks that have a self-directed IRA. Now, most people aren't aware that your IRA could even be required to file a tax return. If you invest in traditional investments such as stocks, bonds, interest, that sort of thing, you're not going to be required to file a tax return for your IRA. However, if you engage in certain businesses that, as a self-directed IRA, that a traditional custodian won't allow you to do so, you could be required to file a 990T tax return. This tax return is due on April 15th or can be extended to October 15th, just like an individual tax return would do. Now, the way this works is any sort of income from business operations, such as if you're investing in a restaurant or maybe a golf course or any sort of business that is an active trade or business, would subject you to this unrelated business income. Now, exclusions from this UBI includes dividends, interest, most rental property, and passive investment income. Now, IRAs, once their net income reaches about $10,000, are taxed at 35% and required to file this 990T. I'm just going to simplify this tax rate to 35% for all your income because you're there pretty quickly for the purposes of our examples here. You can also avoid UBIT by forming a C corporation. So maybe you're going to invest in that restaurant. That restaurant could operate within a C corporation, and that C corporation would be paying that tax instead. Now, if the other owners don't want to have a C corporation, that business inside of a C corporation, then you could also loan money to that business instead. Some restaurant owners might be afraid of the double taxation associated with a C corp. So by you giving a loan instead, you don't have an equity interest in the business. However, you can still charge a sizable interest rate and get money back for your investment. You just don't have an equity interest. It's interest income only. Now, unrelated debt financed income. This is typically where I see this is where folks invest in some sort of a passive deal, maybe a multifamily apartment complex, and that apartment complexes utilizes debt. So let's say in this example, we have our self-directed IRA, and they put in $100,000 cash to help buy this apartment complex. So in total, they're a 20% owner. They purchased this property for $1 million. They put in $500,000 cash total between all the investors and get a $500,000 loan. For that year's revenue, they make $120,000 less their operating expenses, depreciation, and such, leads them to a net income of $50,000. The IRA's portion of that income is 20%, subject to that 50% debt ratio. If you see that, the loan of $500,000 to the $1 million purchase price is going to lead us to a $5,000 amount that's subject to the unrelated debt financed income. Multiply this by the IRA tax rate of 35%, leaves us to an amount due of $1,750 that your IRA would now be required to pay in taxes. Now, if you are going to do a significant amount of these type investments, you could also consider setting up a self-directed 401k plan if you have a business. 401ks are statutorily exempt from UDFI, and it's one way to kind of try to get around this whole UDFI scenario. Now, getting into our 2014 tax update, there's a new Medicare tax, this 3.8% Medicare surcharge on unearned income or investor income. Now, your net investment income is made up of your interest, your dividends, capital gains, annuities, your net rental income, your royalties, and any passive activity income. What's not included is your W-2, active trade or business, any distributions from an IRA, and your self-employment income. Now remember, while your distributions from an IRA may not be taxed directly, getting a distribution from an IRA could push your income up, your level up high enough where investment income that's not normally subject to this new Medicare tax could otherwise be subject to this Medicare tax. Such as, let's say, for example, you make $20,000 in investment income as a married filing joint couple. However, and you also have $240,000 worth of earned income from your W-2 job. Now, this tax kicks in only on the excess of your investment income that exceeds that $250,000 if you're married filing joint. So in that example, the $10,000 of the investor income actually exceeds that $250,000 and would be the portion that would be taxed. Moving on to another example, John, a single, has $270,000 worth of adjusted gross income, which exceeds that $200,000 threshold. The adjusted gross income includes a $210,000 salary and $60,000 worth of investment income. That 3.8% surtax applies to the $60,000 for a $2,200, almost $2,300 worth of Medicare surtax. Capitalization of tangible assets. Capitalization is when you purchase, let's say, a rental property and you do a rehab on that property, let's say for $30,000. That $30,000 you put into that rental property is not deductible immediately. That's something that needs to be capitalized and depreciated over a period of time. So capitalization has to do with whether or not you're going to, one, make it an asset that you have to depreciate, or you're going to expense it and recognize the deduction currently. So there were new finalized regulations that were put into place as of September 19th, 2013. And more than anything, these rules serve to help clarify the previous rules that were in place with the IRS. There's some bigger gray areas previously. And so the general rule for capital expenditures is that you must capitalize any amounts paid for new buildings or improvements, any amounts paid for a restoration or a betterment of the property. A betterment is an expansion, an increase in efficiency, or an increase in quality. So the general rule of thumb here, if you are going to be doing Rental property is all the costs that are associated with getting that property available for rent are going to be capitalized initially, and then from that point forward, you're going to expense some of those costs. So the closing costs related to the acquisition, such as legal, title, recording, are also going to be capitalized in with the building. And the closing costs or the points related to the loans are capitalized and deducted over the life of the loan. So let's say you purchased a house or refinanced a house with a conventional loan, and you paid $3,000 in closing costs for that loan. And if it's a 30-year loan, you would then deduct $100 a month for 30 years, $100 a year for 30 years until you had fully deducted those points. On the other side, we have materials and supplies. So these are expenses that you can write off currently, and they are costs associated with maintaining a component of property, such as an HVAC. So any parts you buy to maintain, repair, or that property are going to be written off as you go. Now, if there's an increase or a significant increase in efficiency or productivity of that unit, then that's something you would capitalize. So examples of these materials and supplies would include light bulbs, air filters, touch-up paint, and it's not anything that you need to track as inventory. It's typically consumed within 12 months or less. Now, one of the new concepts that the IRS introduced was de minimis. It's not really a new concept, but it is something new for the capitalization requirements. So what this says is, previously, if you bought a $125 microwave and you're going to put it into your property, you were going to have to depreciate that over 5 years, capitalize it, and you couldn't take the deduction currently. However, with this de minimis, since it's under $200, then you can write it off currently and you don't have to capitalize it. If you put in a written accounting policy in place prior to 2014 or the next tax year, then in that year you can deduct up to $500 or more, or less worth of costs that may otherwise be previously had to be capitalized and depreciated over a period of time. So where this really helps out is, let's say you have an apartment complex and you bought 100 dishwashers for your complex. Maybe you spent $450 per a piece on these dishwashers. Previously, you would have to capitalize and depreciate these assets over 5 years as appliances. However, as long as the cost of the dishwasher plus the installation and delivery is $500 or less, you can write off those costs in the year that you actually utilize those dishwashers. Now, what's not on here is if you have audited financials and you're a little bigger operation, you can deduct up to $5,000 or less. Now, if you want to take this election, you just need to attach a statement to your tax return for that section, and going forward, the IRS will allow you to take this de minimis rule, but you do need to apply it to all your future purchases. Now, where I could see this being a potential downfall is if you're trying to qualify for loans and you make this election. That means going forward, you're going to be expensing as repairs and maintenance all those appliances that could otherwise be capitalized and depreciated. Since if you have those large items taken as repairs and maintenance, they will count against your debt-to-income ratio for the purposes of calculating what you can get a loan for. So this is something that I will work with clients on an individual level to help them determine what the best strategy is for them, because for some it is going to make sense for them to go ahead and take this election because they want to maximize tax savings. For other folks, they'd rather pay an extra $1,000 in tax and continue to qualify for loans for the next year. Now, you do need to capitalize if you buy a house and whatever that rehab or repair is a pre-existing condition, or if you fail, if there's a failure or poor maintenance of an asset that results in deterioration, so it's no longer functioning, the cost to bring that component back up to so where it's functioning properly would be capitalized. Now, For it to be a repair, it's typically an inspection, cleaning, testing, and replacement of worn parts with comparable parts. Now, something is considered routine and also deducted currently if it's serviced 2 or more times in a 10-year period, according to the IRS. So I actually think there's an argument here that you could make that if you have carpet that you have to replace every time you have a turnover, and let's say you have 3 turnovers in a 10-year period, I think you can make the argument that since you're having to replace that carpet more than 2 times in a 10-year period, then you could really write that carpet off as a current period expense rather than having to capitalize it. Now, working with our last example, let's say your hailstorm hits a roof with 15-year shingles. So a hailstorm is an act of God. It's not a pre-existing condition. It's not something resulting from your poor maintenance. It's just something that happened. If you were to replace those shingles with 15-year shingles, which is what the same thing that we had before, it's not a betterment, it's not an improvement, it's just the same thing, you could potentially write off a $5,000 roof repair for something that would otherwise have been previously capitalized and depreciated over the life of the house, 27.5 years. However, if you were to replace that roof with something better, such as a 30-year shingles, then that is something that would be a capital asset, and you would have to capitalize and depreciate. The Obamacare Affordable Care Act. So this is the year as of January 1st, 2014. If you do not have health care coverage, you will be required to pay a shared responsibility fee. So this law requires all taxpayers and their dependents to have health care coverage. So this penalty kicks in slow in the beginning, and as you can see, it becomes bigger as the years go on. So this penalty is 1% of your taxable income, or a maximum of $285 per family, and you can see by 2016 that's up to 2.5% of your taxable income, or a little over $22,000 per family. Now, you are exempt from this penalty if you have a lapse in coverage for 3 months or less. You're covered by Medicare. If you are incarcerated or an undocumented immigrant, you are not required to pay a responsibility fee. If your insurance premiums exceed 8% of your adjusted gross income, you're also not required to pay the shared responsibility fee. Now, Obamacare does allow for some subsidies. These must be applied for directly through the Affordable Insurance Exchange. That's that infamous website that we've all been hearing about, so hopefully you can actually get through it. These subsidies are aimed at people with incomes between 130 and 400% of the poverty line. So a family of 4 will have their phase out of their subsidy phase out with income somewhere between $23,000 and $92,000. And these premiums, these insurance premiums, are capped as a percentage of their income. These subsidies can be sent directly to the insurance exchange to pay for the premiums, or if you prefer, you can have them received as a credit on your tax return. Now, what I find interesting here is this bill gives little remedy for the IRS to actually collect these penalties. The IRS can't use interest, liens, or levies to collect the tax most of their traditional ways. If you don't pay your taxes, they can only offset your future tax refunds. So for those that really wanted to avoid these penalties, you could potentially not, and you could ensure that you're not getting any tax refunds and avoid paying the penalty. However, I think in the long run, the IRS tends to find a way to get their money. Now, in order to take advantage of tax strategies, you do need to have good record keeping. This is a system in place to track your income and expenses. I strongly suggest getting a separate bank account for each business. And what the benefit there is, it'll help you, one, for your own purpose, that you know for every income or expense that runs through that specific bank account must somehow be accounted for your business, as opposed to being intermingled with your personal accounts. If you intermingle things with your personal accounts, you go through an audit, I think the IRS would potentially add a little extra scrutiny there, because they can tell you're not running it like a business, and they might question how you know what's legitimately a business expense or not and require more substantiation of those transactions. Now remember, you will need to track each house separately since they're reported separately for tax purposes. You need to be prepared to substantiate claims on your tax returns, such as if you're taking a large deduction, you need to make sure you've got the receipts and documentation to support it. Especially receipts $75 or more, you need to keep them for a minimum of 3 years. From your receipts, you should be able to tell what was bought, where it was bought, how much it costs, why it was needed, and if it was meals and entertainment, you need to make sure you know the business purpose and who you were going to, if it was a dinner, who you were going to dinner with. Now remember, the IRS will contact you 1 to 2 years after the tax return is filed, typically for an audit. I personally can probably remember 2 or 3 years back what a specific transaction was for, but after that it gets a little fuzzy for me. So having a good record-keeping system is really valuable. Now I think accounting software is a great way to do this. It'll help you stay organized. Since it will force you to do a bank reconciliation, this will mean that you are forced to go through every single transaction in your bank account and assign it one way or another. So this will help you ensure that you're not missing any transactions, because if you miss a transaction, that's a potential missed deduction. For those of you who do hard money loans, one of the most frequently missed deductions is the hard money loan draw fees. So whenever you are rehabbing a house, typically the hard money lender holds back some funds for you to do the rehab, and then they'll reimburse you as the rehab is completed. Those fees typically range between $75 and $150. I had a lot of clients that forgot about those this year, but I did try and remind folks as I saw that they were missing. So also having an accounting software could potentially help you save money in a potential audit. You may be able to get through it quicker if they can see that you've got a clear system for keeping track of your receipts. If every time they ask you for something, you're able to bring it up quickly and accurately to support each of their requests. Accounting software also helps give you a pulse on your business so that you can go in and see at any time how much money you've made on a per property basis and how much you're into a property for. Your balance sheet is useful if you're going to do any sort of a business tax return, such as a partnership or an S corporation underneath an LLC. I do recommend QuickBooks because it's most commonly used. The most amount of accountants out there are familiar with it. And I do teach a QuickBooks class for real estate investors that specifically goes over how to set this up for folks that are working in the business of real estate. It has template transactions to easily enter in your HUD-1 closing statements, and it's really transformed it into a property management software. IRS audits, they're time intensive and expensive even when you're right. Now IRS staff are running thin. Audits have fallen due to Obamacare, identity theft, and budget cuts. After the scandal last summer, Congress has, almost in retribution, it could be argued that they were cutting their budget. It's fallen by several $billions. As a result, the audit rates have gone down. So the audit rate for all individuals is at 0.96%. It's typically over 1%, which is kind of a big deal. So if you're making between $0 and $200,000, your audit rate is 0.88%. If you're between $200,000 and $1 million, your audit rate is 2.7%. If you're $1 million or more, your audit rate is almost 11%, which works out to be about 1 in 9 of you will be audited if you're making over $1 million. At that point, it's not a matter of if, it's more of a matter of when. So ways to reduce these audits is to move more of your activities over to partnerships or S corps. Those only have an audit rate of 0.42%. So if you're making $200,000 or more, if you move some of your activity over to a partnership or S corporation, that means your audit risk goes down almost 6 or 7-fold. And you see C corporations and tax-exempt organizations are on there as well. So this is one of my biggest tax strategies for just managing audit risk, is moving things off your individual return to a partnership or an S corp. Now, audit flags. Audit flags, the biggest number one audit flag is having a small business on your individual tax return, such as a Schedule C. They continue to just be a goldmine for the IRS. Now, what's new is in 2011, the IRS announced a focus on rental property. There's a lot more investors out there that are getting involved with rental property, and the IRS is paying attention. So once again, anything you can do to get that off your individual tax return from a Schedule E to a partnership or something else is going to be an advantage. Also, claiming real estate professional status as an employee. To be a real estate professional, you have to spend 750 hours or more, and spend more time as a real estate professional than you do in your day job. So that means if you spend 2,000 hours a year as an employee, you'd have to prove that you spent 2,001 hours a year as a real estate professional, which is why that's such a big target for the IRS. We'll cover a little bit more on that status later. Also, claiming 100% business use of vehicle. So when you're driving around your car, you may go for groceries, or you got to do a commute, you're commuting to the office. Both of those are personal expenses. So the likelihood that not once in the entire year that you commuted to the office or ran any personal errands is very unlikely, which is why people who take 100% business use of the vehicle have a much higher chance of audit. The IRS is cracking down on foreign bank accounts. Swiss accounts aren't nearly as anonymous as they used to be. If you're taking higher than average deductions for your tax return, if you're writing off hobby losses, such as if you have a car racing business that never makes money, that would also be an audit flag. If you're deducting business meals, travel, and entertainment expenses, taking large charitable contributions. Now, I had a client this last year who made about $180,000 or so and deducted and had about $70,000 worth of charitable contributions that they could have deducted. And when I actually saw the letters, I saw the canceled checks, so I knew that they had truly given $70,000 to their church. However, they were worried about an audit, so they only deducted $10,000. So this is where I will work with clients. If they are that worried about an audit, I will help them manage that audit risk. Me personally, if I got the documentation to prove it, I think I could have come out of that audit rather easily. Since I saw the support right there, but that's up to them, and that's how I'm able to work with various clients based on what their own comfort level is. If you make too much money, as you saw a moment ago, if you're making $1 million or more, you've got about a 1 in 9 chance of being audited. If you fail to report taxable income, so those W-2s and 1099s you receive, the IRS gets a copy too, and when you file your tax return, they're going to be looking to match those amounts up that they receive with your tax return. If they don't see it, they're going to send you a letter. Also, if you're claiming a home office or taking an alimony deduction, these are also audit flags. Common sense tax planning. So sometimes I'm out with folks and they talk about, well, they're going to spend $1 or they're going to buy something extra just because it's tax deductible. Now, when you spend $1 to get a deduction, truly, if you're in the 25% tax bracket, you're only receiving a quarter back in return on your savings. So that doesn't always make sense to just spend $1 just for the sake of getting a tax deduction. There needs to be a true business purpose as well. Ways to legally reduce your taxes. These are my 4 tax planning principles. The first one being tax rate reduction. This will lead to a lower tax bracket. Taxable income reduction. Less equals less taxable income. Tax deferral means that you pay tax later. And tax avoidance is you legally never pay tax. Ways to reduce your tax rate, including holding your assets for a year or more to qualify for the lower capital gains rate, typically 15%. You're also going to want to be aware of the broker-dealer status. If you're house flipping, once you're determined to be in the business of house flipping, that means your earnings are now subject to a 15.3% self-employment tax. Now, this is a facts and circumstances test whether or not you're in the business. So the courts have held traditionally somewhere around 5 houses in a year is what seems to give you broker-dealer status. So if you're just doing 3, 4 a year, you could probably avoid this. but this is something to be aware of as you get into the higher amounts. And once your income gets high enough from flipping houses, you may consider using an S corporation to avoid self-employment tax once a reasonable salary is paid. So what this means is, let's say you're in the you have a small business. Having an S corporation is small business 101 savings for your business. So if you are making somewhere between $50,000 and $75,000, you set yourself maybe a salary of $75,000, then the excess above that $75,000 isn't subject to self-employment tax. However, if you had a Schedule C and it went directly on your individual tax return, then that additional amount would be subject to that 15.3% self-employment tax. You're also going to want to watch your income thresholds to avoid additional tax. So if you're taking out an IRA distribution, I had a client this last year who took out about $750,000 from their IRA following a real estate guru's advice just to cash out. He ended up paying about $300,000 worth of taxes as a 77-year-old man. What makes matters worse is he was going to use that money to invest in a multifamily apartment complex. However, a complex wasn't available for a year and a half, so that money just sat there on its own, not having any earnings as the stock market recovered. Eventually, he did get into a deal, but it was at a heavy price. If you are going to be taking money out of an IRA and invest that way, I would suggest that you do so on an as-needed basis versus just taking it all out and letting it sit there. Also, broker-dealer status will cover installment sales and owner financing later, but it does disallow that installment sale treatment. The installment sale treatment is, let's say you are going to sell a house that you originally bought for $100,000, you're going to sell it for $130,000. So that's a $30,000 gain. You sell it on a 30-year note. Under the installment sale treatment, you can recognize just $1,000 per year in terms of your actual gain because you're spreading the income you've received over the life of that note over 30 years. However, if you're found to be a broker-dealer, you recognize that entire installment treatment up front, then you disallow that installment sale treatment, which means that even though you're getting a note, your interest on a yearly basis, you now have to pay taxes on that full $30,000 in the year that you sell the house, even though you haven't received the $30,000. So from that perspective, it's not very favorable. Now, a self-rental, what this does is, it's been around for a while, but as a business, it allows you to subject your self-employment income in an active trader business, and you pay rent to yourself, so you're generating a rental expense against your self-employment active trader business type income. So the net effect is your small business takes this rent expense. On the other hand, you are having to recognize rental income. However, your rental income is not subject to the self-employment tax. So the net effect is the amount of your rent, you are essentially transforming that income from being subjected to self-employment to not being subject to self-employment tax. Now, the rules do get tricky here. I would definitely suggest talking to a CPA because you want to do this right. The basics are that you need to sign a rent and lease with rent at a fair market value. You want to actually make the rental payments from one entity to another. So this doesn't mean just some sort of an accounting transfer. You actually need to write checks back and forth between these entities. Now, the best practice to make this work is having a business owner's entity rent from a spouse's entity or a similar arrangement, so you're not just moving money around on your individual tax return, renting from yourself from your Schedule C to your Schedule E. That's where the courts have tended to bust up these kinds of arrangements. Taxable income reduction. So this is to demonstrate the difference between how you're treated from an employee perspective versus having a small business. As an employee, your gross income is multiplied by the tax rate, and you don't get a direct write-off against that gross income for your unreimbursed employee expenses or other costs you incur as an employee. However, as a business, you do have your gross income and you get to write off all your deduction as depreciation, and the tax is only applied to your net income. Much more favorable. Now, ways to reduce your taxable income. Now, most folks are familiar with the fact that you can deduct your actual expenses when you're traveling and your meals and entertainment as well. Now, there's also an option for you to deduct your per diems instead of your actual expenses. So if you're traveling to the DFW area, then you can deduct $123 for a hotel, even though maybe you only spent $60 at a budget hotel. And likewise, if you only spent $10 at McDonald's, that's where you took out your business associates to, you could pocket that difference and deduct that full $71, and so you're pocketing that difference of $61. Now, these per diems are based on the city, the zip code of wherever you're traveling to, so I'd suggest checking out gsa.gov to get these per diems. You can also contribute money to a 401k or an IRA plan. Funding a health savings account is something I think everybody should take a look at. The reason being is currently to deduct medical expenses, it's getting tougher and tougher. So let's say you made $100,000 worth of adjusted gross income. You can only deduct your medical expenses once they exceed 10% of your adjusted gross income. So in that example, once your 10% of $100,000 is $10,000, so only the medical expenses in excess of $10,000 would be deductible. However, as an HSA, you get an immediate deduction against your adjusted gross income for any contributions made to an HSA. So maybe you don't use those funds that year. However, if you're starting a family, plan to have kids someday, or maybe you're looking towards retirement and you know you're going to have additional medical expenses, you can let those funds sit there and then use them as they come up. So your distributions from a HSA, a health savings account, are non-taxable as long as they're used for qualified unreimbursed medical expenses. You're not being reimbursed for those medical expenses by an employer or something. Now, you could also sell any non-performing assets at a loss to offset other gains. So non-performing assets are things such as stocks, bonds, a house that aren't doing so hot that you don't really expect to recover. So let's say you're selling one house and you have a $50,000 gain on the sale of that house. On the other hand, you have a second house that really hasn't done so hot, you haven't been able to rent it, or it's actually lost value. You could sell that first house and maybe have a $30,000 capital loss to offset that capital gain that you're going to have on the other side. Now, I'm not suggesting you go out and lose money just for the sake of having a write-off here. However, if you have assets that aren't doing so hot anyways, this might be an opportunity to offload them. Go ahead and accept that loss and offset your other gains against it. You can also donate appreciated stock directly to charity. If you donate it directly, you receive a deduction for the value instead of your cost. You can also have a baby and get another exemption of $4,000. However, I think having a baby may cost you more than $4,000 a year, but if you were on the fence of having another, maybe tax purposes is the reason why you would like to have that additional child. You can also use your real estate losses to offset earned income. You're also going to want to maximize your real estate and business expenses to help reduce your income as much as possible. We'll go through the rental real estate losses here in just a moment. So your common landlord deductions include advertising, auto expenses, traveling to your houses, going to Home Depot. You can deduct those at 56 cents per mile for 2014. You do need to keep a mileage log of where you started, where you were going, and the purpose. Also, you can deduct your depreciation, your insurance, your interest, your hard money draw fees. Now, your home office, traditionally you could only deduct your actual expenses. So let's say you have a 200 square foot office that's solely used for business, no spare bedroom or anything like that, out of a 2,000 square foot house, that 200 divided by 2,000 square foot implies that 10% of your home is used for your home office for business purposes. So that would then mean that you could take your mortgage, your property taxes, your utilities, your homeowners association dues, any other expenses associated with the house, and deduct those as a business expense. So to simplify things, the IRS said that they'll now give you $5 per square foot of office space up to 300 square feet, which means that you don't actually have to always calculate the actual method and just keep things a little more simple. This deduction is capped out at $1,500 because you're only allowed to deduct a maximum of 300 square feet under this method. 5 times $300, 300 square feet is where we're getting that that $1,500 write-off. Now, homeowners association dues are also deductible. Any dues you pay for lawn service, pest control, carpet cleaning. Professional fees such as attorney, CPA, property management, your property taxes, your repairs, if they're expensed, you get a write-off directly. If they're capitalized, then you take it through depreciation instead. Also, your telephone, your business usage can also be deductible. Now remember, the IRS also has a rule that if you are going to deduct your telephone, you still need a landline for personal use, and then your cell phone can be used for business. Any utilities bills that aren't paid by your tenants are also deductible by you. Now, to give you an idea of how a house purchase works and the depreciation of it, let's say you purchased a house for $60,000. You put $20,000 into the rehab, then you have $80,000 worth of basis. And your basis is just what you've got in the property, also includes any acquisition costs. You're going to have to back out the land value because land is non-depreciable. You can take a hammer to the dirt all day long, and no matter how much you hit that dirt, that land's really not going to lose any value. So your depreciable basis in this case, you deduct you take $70,000 divided by 27.5 years. If it's a residential rental property, gives you the $2,500 or so with the depreciation. You've got your $12,000 worth of rental revenue, less your mortgage, interest, property taxes, insurance, other costs, and depreciation, which actually gives you taxable income of $1,355. Now, what some folks may have heard from various gurus out there is that depreciation makes your rental property tax-free, your income tax-free. However, I prefer tax-deferred. So most folks, they talk about the phantom expense associated with the depreciation, but they don't talk about the depreciation recapture when you go to sell a house. So let's say you bought a house for $100,000. You hold it for a few years, so based on the depreciation, it lowers your basis in the property. You have $20,000 worth of depreciation. It lowers your basis down to $80,000. Now later, you sell that house for $130,000. The difference between the $130,000 and the original cost, most people would just think, well, I have a $30,000 gain, and so I'll be taxed at 15% on that capital gain. So that part is true, but what folks are forgetting is you have that additional $20,000 worth of depreciation recapture that you had previously taken that is recaptured at your ordinary tax bracket. So in reality, you're paying tax on a $50,000 gain in that case, not just the $30,000 capital gain that most people are thinking of. That's why I prefer to say depreciation makes real estate tax deferred versus tax free. Now, your rental real estate losses, up to $25,000 worth of rental real estate losses may be taken as a deduction against other earned income. This phases out, however, between $100,000 and $150,000 worth of adjusted gross income. They set these limits back in the late 70s, and they haven't been adjusted for inflation since, which means a lot more people are being subject to this phase out than was initially intended in the 70s. So in order to qualify for this deduction, you must be actively involved in your real estate. It's pretty easy to prove this part. And this means that you're locating and purchasing that house. Maybe you're involved with the rehab of the property, you're working with vendors, you're approving tenants, lease terms, rent collection. This is pretty much a give me. Now, if your income is above $150,000 worth of adjusted gross income, you don't get to take these losses immediately, so these losses are carried forward. They're not lost. They're carried forward until one of four things happens. Either one, your income falls below that $150,000 threshold and you can start taking deductions. Two, you sell the house. At the time you sell the house, then you get an immediate write-off against your property. Thirdly, you have gains or future income to offset those losses at a later year. Or lastly, you become a real estate professional. Now, this phase-out is proportional. So if you have $125,000 worth of adjusted gross income, that's halfway in between, which means half of $25,000 worth of losses is $12,500. So if you had $125,000 worth of adjusted gross income, you could take up to $12,500 worth of losses. So as a real estate professional, this means you're not subject to any phase-out. You are able to deduct all your losses in the year they occur. In order to qualify, you must have 750 hours or more in real estate, and more than half of all your hours must be spent in real estate. So if you spend 2,080 hours at your job, you must be able to substantiate you spent 2,081 hours in real estate. So this real estate professional test is a facts and circumstances test. If you own maybe 5 to 10 rental properties, you'll probably want to keep some sort of documentation like a time card to keep track of your time in real estate. However, I have another client that is actively flipping somewhere between 15 and 25 houses at a time. That guy is running around so crazy all the time just dealing with this real estate. It's very easy for the he doesn't need to keep a log because it's very easy for the IRS to understand that based on the sheer amount of volume he's doing with his houses, that he is easily over that 750-hour requirement. Now, to qualify, either the husband or wife may qualify for the both of them. So one example that seems to work is maybe the husband is involved in corporate America and it's the wife handling the real estate. She focuses on that, and since she's able to qualify as a real estate professional, she qualifies for the both of them. Now, being able to deduct your real estate education, there's a lot of investment groups out there that are selling their real estate education and like to claim that their particular program is tax deductible. Now, if you ask them how to deduct specifically on their tax return, they typically say, go talk to your tax return, your CPA. However, as the CPA, I can quote the guidance from the IRS publications that say investment-related seminars, you cannot deduct these expenses for attending a convention, seminar, or similar meeting for investment purposes. Now, this does not mean you can't deduct it at all. It just means that the when and how is a little different. So in order to deduct it, you must somehow relate the cost of the seminar directly to the acquisition or operation of property or business. So let's say you attend an investment seminar and they teach you about property management, and you go back and you have a property, you have an apartment complex. You can easily tell that that class directly contributed to your knowledge within that apartment complex. So like I said, the what and how can sometimes be a little tricky. As long as you actually do buy real estate at some point, you can likely deduct those expenses. Now, you can also deduct your college tuition as a business expense if the education was required by an employer and there's a legitimate business purpose. So let's say, for example, you're working as a financial analyst and your employer wants you to be a manager for them and they want you to get an MBA. If they don't directly reimburse you for the cost of the MBA, then you could deduct that MBA because they wanted you to have it for a legitimate business purpose. It maintains or improves your skills for your present line of work. Now, this will not qualify you for a new business. So if you are out working on a new degree for something previously in a new line of business that you haven't done, and it's a career move, then you can still take the deduction for your tuition if it's a qualified school, and there's ways to deduct that, but you can't take it as a business expense. So calculating your underwriting income. When I first bought my first 3 houses back in 2010, I thought I was quite the tax whiz and deducted as much as I could and got a pretty good sized refund check back from the IRS. I thought I was doing pretty well for myself until I went to try and refinance that 4th house and at that point the underwriter said, well, you've lost money on your first 3 houses, why would I give you a loan for the 4th? So it really changed the way I looked at tax returns. So it's no longer just a matter of trying to save the most amount of money possible, although that can be a goal. Sometimes I'm looking at trying to ensure that I qualify for additional loans, and there's certain ways to prepare tax returns that may or may not give the same net benefit but are much more beneficial from an underwriting perspective. To give you an idea of how underwriting income is calculated, the underwriters will take your rental income and then they'll add back any depreciation or amortization you've taken. So I've read through the Fannie Mae underwriting guidelines that are published as they relate to tax returns. I've got a good feel for those, and I'm more than happy to assist with any sort of letters you need from an underwriter explaining how things need to work from a tax perspective. And so one other service I will offer is I will work hand in hand with your lender. So if you give me permission, I will send a copy of your tax return over to your lender and he can review it prior to us filing the final return and just ensure that you can continue to qualify for loans for the next year. Now, C corporations as a management company. So this is a strategy that I typically use once you have maybe 10 or more rental properties. And the way this works is that your LLC's holding companies pays a C corporation a management fee in excess of the corporate expenses to ensure a small profit. So this arrangement allows you to deduct certain costs like your health insurance, medical reimbursement, and set up like a corporate 401k plan or a self-directed 401k plan that you couldn't otherwise do on your own as an individual. Now, remember, you need to extend the same health insurance coverage and corporate 401k plan to all your employees of your C corporation, but that's really not so bad if it's just you and maybe a spouse that are owners in this company. You can also shift your loans. Maybe you own a car for the business over to the C corporation, and then it no longer will show up on your personal credit report. You can also offset passive rental losses with operating income. So if you're subject to certain limitations on how much you can deduct on your personal tax return, this is a way to help offset some of your other expenses through here. The first $0 to $50,000 is taxed at 15%. The cons of having a C corporation is you do need to keep track of your separate records and minutes. You will need to get a separate bank account. Of course, there's an additional tax return associated with this as well. And there's also the double taxation. Now, the way this works is most folks are familiar with if you invest in a Fortune 500 company like Microsoft, when they make a profit as a C corporation, is going to pay tax on it. And then, in turn, if you're a shareholder in Microsoft, they're going to send you a dividend. And you, in return, you're going to pay tax on that dividend as well. So if it's your own personal C corporation, then that C corp is going to pay tax, and then if you receive a dividend, you're also going to pay tax. So that's why you're paying a small profit, just enough money to exceed whatever expenses you have, so you're not worried about trying to get money out of your corporation. If you do get to a point where you are, you could also give yourself some sort of a payroll check, and that may be more beneficial than trying to subject yourself to the double taxation here. Now, why do we defer? We want to defer as long as possible in this example, because let's say you have $100,000 to invest and you're making a 10% profit you're making a 10% profit, which is pretty decent. But if you're paying the taxes along the way, in year 2045, you're going to have $1,038,000. That's paying as you go. However, if you decide to defer the tax, you get to keep that money in the business, or you're continuing to earn on those funds, and you pay it out at the end. Then at 2045, you're going to have $2.1 million, and you're going to pay it the tax at the end. So net, you have almost $550,000 more worth of net income if you can defer. Other reasons to defer the timing and other reasons to defer and why you may want to manipulate the timing of tax. Let's say your IRA distributions, if you take them over time to avoid pushing income into a higher tier tax bracket. This is where I was saying that take your IRA money if you choose to not to invest within your IRA on an as-needed basis, so you're not getting these huge jumps that are subject to the highest tier tax brackets. Other ways is sometimes you do want to split it up between years, or you're willing to be subject to a slightly higher tax bracket in one year versus the next, because you want the option to deduct your rental real estate losses. So if you remember earlier, your real estate losses phase out at $150,000 worth of adjusted gross income. So let's say your wages are only $100,000 worth of income, and you want to get $100,000 out of your IRA. So if you did $50,000 a year, with no tax planning, no rental losses are deductible. However, with a little tax planning, maybe you cash it all out that first year, you've got immediate use of the money, you might pay a little bit more in taxes. However, that first year, no real estate losses are deductible. But here the winner is that in that second year, you can deduct all your rental real estate losses, and maybe you've been able to place your IRA money a little sooner than you had planned to do so. So other ways to defer tax, you generally want to defer income and accelerate expenses. This is Tax Deferral 101. Ways to defer income in relation to real estate is you're planning the date of the property sale. So maybe you have a house in December that you are looking to sell. You can often delay the closing date to maybe January 1st. Just give it an extra few days to push it off to another tax return. And that's you don't have to pay the tax for a whole nother year. Now you could also plan the date a house is available for rent. Now the year that the house is available for rent, you do have the tax preparation costs of including that in your tax return. More importantly, from an underwriting perspective, more of that house's expenses will be counted against you for your debt-to-income ratio. Now, neither one of these strategies work if you have a house that's available for rent or you're looking to sell a house in June. It doesn't make sense to wait 6 months to use one of these strategies. But if you're right around the end of the year anyways, that might be one way. I also mentioned installment sales allow you to deduct the gain on the sale over a period of time. You can also accelerate your expenses. So here in Texas, you can actually deduct 2 years worth of property taxes in a single year. In Texas, you have the ability to, you have the payment period for your property taxes anywhere between September to January the following year. So maybe in 2014, you actually paid your 2013 property taxes in January 2014, and then you could turn around and pay 2014's property taxes in December of 2014. With that, you could deduct 2 years worth of property taxes. Now, you could also prepay a month's worth of expenses. As long as you write and mail the checks before the end of the year, you can deduct those costs as long as the checks were mailed. There's also a 50% bonus depreciation that allows you to accelerate your depreciation on new assets such as your carpet, appliances, fence, or your vehicle. Now, your estimated taxes, these are taxpayers that make, so those that are involved with a small business or you make any significant money, the IRS encourages you and actually requires you to pay that money as you go. If you don't pay your taxes based on when you make your money throughout the year through quarterly tax payments, then there are underpayment penalties. However, you can avoid this penalty once you've paid in what last year's withholding was, if if once you've exceeded 100% of last year's tax, or if you've paid in 110% of last year's tax if you're making $150,000 or more, then you're exempt no matter how much money you make. So let's say you had a big deal go through in February of 2014. Now, as long as you paid in as much tax as you did last year, and you made the quarterly estimated tax payment with as much money as you made in 2013, rather than paying the full tax on that gain of $1 million, you could defer that all the way out until April of 2015. So you've got use of those funds that you can do something else with for that entire extra year. Now, some of my other clients who are real active and good about placing their money also understand that if they don't pay their taxes as of April 15th of that following year, then there are then IRS penalties that also kick in. However, those penalties may only be 4 or 5%, and they'll wait to file their tax return all the way until October 15th. And so they would rather use those funds for an extra 6 months at paying a 4 or 5% interest rate versus going out and trying to borrow money at 10%. So this is just something to be careful of if you do consider it. Of course, as a CPA, I suggest you always pay your taxes on time when they're due, but this is just some examples I've seen that other folks have done. Owner financing. So the benefits of owner finance is that you can get yearly cash flow. There's additional interest income. Where I have really liked this strategy is, and I've done personally, is let's say I actually bought a house that was built in the 1950s. I could tell that there were going to be some repairs associated with it, so I fixed it up to where it needed to be now, but I could tell in another 5, 10, 15 years that the plumbing system, maybe the electrical system was going to need to be replaced. I didn't really want to be responsible for that, but nor did I just want to give it up completely. So what I did is I found a tenant that wanted to live in the house, and I could tell from the tenant that they may be looking to purchase a house in a year anyways. So I rented the house to them for a year. So since I had held the asset for a year, I now qualified for long-term capital gains. After that year, I went to the tenant and said, hey, I'm interested in selling the house before I put it on the market. Would you be interested in buying the house? The tenant was interested in purchasing the house. So then I sold the house to him, got a large down payment of 10 to 20%. In my case, I actually got 15% down, so I got cash out. And then I received a 9% interest loan that was amortized over 30 years, but actually payable in 15. So there was a balloon on the note in 15 years. So the tenant who had previously struggled with bankruptcy had since recovered, but their credit had not recovered, was able to qualify for that house. I got a house that I was now hands-off. I didn't have to deal with property taxes, the maintenance with the property, and I was actually making more money from the interest on the note than I was previously making just from my net rental income. So that was a real win-win for both me and the tenants. And like I said, I get to be hands-off. It's one of my favorite tax strategies out there. And it's also just an alternative method to selling a house. If you're having trouble flipping a house, you might check out owner finance instead. It's not necessarily something I'm going to do all the time, but it's one more tool I have in my investor tool belt. So the cons are, if I start doing too many of these, I do qualify for the broker-dealer status, where I would then have to recognize the gain up front, which isn't nearly as favorable. If you're losing money in the house, you don't allocate those losses over 30 years. Instead, you get to use those losses all now, which is also favorable. I also want to point out is most folks that end up doing owner finance at some point sell their notes and just try and get the cash now versus holding on to them to the completion. My exit strategy on this house, for me personally, will be to either get refinanced out of the note, or in 15 years they have plenty of time to refinance. They could also sell the house if needed. but the folks were planning on getting their credit up and then refinancing me out in 3 to 5 years, which still works great for me. So a 1031 or like-kind exchange, what this does is, let's say you're involved with a rental property that has appreciated in value. So you have an apartment complex that maybe you bought for $500,000, you fixed it up, it's now worth $1 million. You could then sell that apartment complex and try and buy it for $1 million, and then buy a new apartment complex for $1 million. Normally, if you sold it at $1 million with the initial purchase price of $500,000, you'd have a $500,000 gain that you'd be taxed on. However, under a 1031 exchange, you can roll that old gain into a new property. So let's say you roll that big $500,000 gain, you buy $1 million property, and then a couple years from now, it's worth $2 million after you've gotten the right kind of tenants in there and you fixed it up. Now, once you fixed it up, it's worth that $2 million. You could then sell your house. You could then sell it, or you could hold on to it for a period of time. And there's actually a great strategy combined with death, of all things. So you'll see how you can use death to permanently avoiding taxes. To facilitate a 1031 exchange, you must hire a qualified 1031 exchange intermediary to help escrow the funds. Upon sale of that first property, you may identify 4 or 5 new properties within 45 days, and you must close on one of those properties within 180 days. Now, you can't traditionally get cash out of a 1031 exchange, because let's say I took money out of that first exchange when I sold that first property, that would actually be subject to tax. However, as I had started to say earlier, if you bought that new property for $1 million, it was now worth $2 million after I fixed it up. I could refinance it and pull $1 million worth of cash out of it, and then I could use that cash for whatever I wanted to and not be taxed on it, because the issuance or repayment of debt is non-taxable. Now, if I do want to do a 1031 exchange, I do need to hold that property for a year or two to show that my intent is really to hold the property, not just be flipping the property. And I can do as many 1031 exchanges as I would like to. Now, you can also avoid tax through selling your personal residence. Now, if you're single, you can exclude up to $250,000 worth of that gain, or married, you can exclude up to $500,000 worth of that gain. So one strategy that I'm following personally that I actually got from another client is, I had a client who went out, when he first started out, he bought a $100,000 house. He put $50,000 into it, and it was now worth $200,000. He then sold that first house after 2 years. As long as he lived in the house for 2 of the previous 5 years, he can sell it and be eligible for this tax-free gain. He sold that first house and bought a little bigger house and rolled his gain into that. So he worked his way up, where he eventually bought a $1 million house, had a $500,000 gain of cash that he had accumulated over time. After a couple of years there, he sold his $1 million house, bought a $500,000 house, loan free. He bought that house loan free because he had built up that gain and that cash over a period of time. So this is one way through smart buying that you can actually get a house loan free without having to do principal pay down. Now, it did take this gentleman 13 years to do so, and it did require some moving, so you do have to be comfortable with that aspect of it, but I think it's definitely something to think about. Now, one other thing you can do is also rent your personal residence up to 14 days tax-free. So there are those out in Hollywood that maybe have a nice house right on the ocean, and maybe they'll rent out their house for 14 days for $1 million, and they know that as long as the crew gets in and out of that house within 14 days, that they can keep the entire $1 million tax-free. And maybe they have a stipulation in the clause that says, if you go over 14 days, you now owe me $2 million to help cover the additional cost of the taxes. You can also fund a Roth IRA, and the money earned within the Roth IRA is not subject to taxation. You can use this Roth for college, your first home, or retirement. Their contributions are never taxable. Now, you could also put money into a Coverdale account for private school. This is real good for parents who are sending their kids to private school. This allows that the earnings used for tuition, books and supplies, uniforms, transportation, etc. aren't subject to tax. As an employer, you can offer your employees up to $5,250 in education assistance, and they can get a deduction, and it's not included in your income. You can also put your kids to work. Hire kids to shift your income from your tax bracket to their tax bracket. Remember, earned income is not subject to the kiddie tax. So this is how you can write off your kid. Actually have them do something. So you could have them clean out your new houses. You could help let them swing a hammer, do the demolition. You could also have them do landscaping. I know most kids these days know at least how to run a lawnmower. You could have them help you with the filing, and maybe if they have high career aspirations, they could be an accountant. Now, if they're under 18, there is no Social Security or Medicare taxes, and if they're under 21, there's no federal or state unemployment taxes. Now, you do need to treat your child like a real employee, written job description, time cards, reasonable wages. You can't pay your 3-year-old $50 an hour to pull weeds. And you also must file all the required payroll forms, including a W-2. Now, this is great from the child's perspective because they learn a little bit about money at an early age. They can use that money to invest in a self-directed IRA, into a Roth IRA, maybe for their college someday, a Coverdale sales account, so you could make them work for that private school that you work so hard to send them to, make them put some effort into it too. And remember, there's no tax return as long as their wages is below the standard deduction. So if they're paid $6,200 or less in 2014, they don't even need to file a tax return. Now, death is something you can typically only do once, but it does allow you to avoid tax, so I do suggest you use this method carefully. So one thing you can do is permanently avoid taxation on your 1031 exchanges. So I had a client that passed away a few years back, and this client was originally out of Chicago, started off buying duplexes in the 60s. And so he started small, but over his life up to his 90s, he had continued to buy apartment complex. When he passed on, he had something like 16 apartment complexes that he owned. And so some of these complexes maybe initially bought just for $500,000. However, over the course of his life, he had maintained the properties. They had highly appreciated in value, and they had now reached about a market value of $5 million. So that one complex, he could have sold it himself, and since it was fully depreciated, he'd have depreciation recapture on the first $500,000 and a capital gain on the remaining $4,500,000. Not very favorable. However, when he passed away, his heirs received what's known as stepped-up basis. So the heir's actual basis in the property is $5 million, the fair market value at what he inherited it at. So even though he had done these 1031 exchanges for years and years, he was still kind of able to thumb his nose at the government when he passed away, and his heirs received that stepped-up basis. The heirs could sell those properties at the time. If they sold them within 6 months of his death, there would be no gain on sale of the property. However, if they did wait another 20 years to sell the property and maybe they had continued to increase in value to $10 million, if they sold them, their value that they would use to calculate their gain would only be $5 million. So the difference between the 10 and the 5 is a $5 million gain, but that's much better than trying to use the original gentleman's purchase price of $500,000. So if you have assets that have lost value, you'll want to give them to your donee at your original basis. Now, the whole valuation of assets, passing them on to your heirs, can be somewhat complex and a little beyond this course. However, you generally do, if they've lost value, you want to give those assets away to your heirs prior to you passing on, versus if they've been highly appreciated, then you'd rather the heirs take advantage of the stepped-up basis. So where do we start? We've covered a lot of tax strategies here. I'm a big proponent of picking tax strategies that match the size and sophistication of your business. I have some folks that come out of real estate guru seminars and they've heard about some sort of legal protection plan. So they come out where they've spent 10 or 15 grand on all these legal entities. Half the time they don't even know what they all do, and they haven't even bought a single real estate property. While I'm not an attorney, I can say from a tax perspective, there is no point in having all these entities set up initially if you can't do anything with them. I'm more of a fan of once you get your business going, or you know what you're really getting yourself into, that's when you start to set these things up. And as you grow and get more sophisticated, you can set up additional legal entities and tax strategies to match the growth and sophistication of your business. You should meet with your tax preparer before the end of the year to help you to implement your tax strategies. For me, it's a conversation of what your personal goals are, your investment goals, and then as an investor myself, I can help merge tax strategy with your investor goals to come up with something that's really going to fit you better. I don't believe in the one-size-fits-all strategy. And any big financial decisions you have throughout the year, or you have a question about something, you should have a CPA that you can give a call to help you talk through the ramifications of that financial decision. So if you have questions or you would like to register for one of my monthly QuickBooks classes on real estate, feel free to email me at keith@theborgfirm.com. You can also check out my website at www.theborgfirm.com, and you can see more information about my services there. Thank you for listening, and I hope you have a good day.